Market Pulse webinar, where we're going to be taking you through the consumer credit trends and economic insights for Q2 of 2023. For those of you who are joining us for the first time, my name is Becky Oakes. I'm the Vice President of Analytics here at Equifax, and I'm delighted to say I'm joined by Kathy Katsouleris, our VP of Analytical Consulting, and by Swanama Pandey, our Head of Insights. Now, as always, before we get started, I'd like to hand over to Sandra, who's going to talk to you a bit about how the On24 platform works. Sandra.
Thanks very much, Becky, and good afternoon, everyone. Each area within the On24 webinar platform is responsive, so you can maximize or minimize each widget or box on your screen based on your viewing needs. There's an Ask a Question widget underneath the media player, so feel free to enter any questions you may have, and we'll address them throughout our session today. In the event there's too many questions to get through, we'll generate an FAQ document, which we'll send out to you in the coming weeks. Today's presentation, as well as some related content in English and French, are available for download in the related content area. This session is being recorded, and you'll receive the on-demand link via email tomorrow. Some additional features on the bottom of the screen that you'll notice are reactions. Let us know how we're doing. There's 2 Register Now buttons, one for our upcoming Commercial Trends webinar on September 14th, and one for our upcoming Fraud Trends webinar on September 20th. There's also our survey, which will pop up at the end of the webinar, and a Contact Us button. Feel free to check any of these out and provide your feedback. Now let's get started. Becky, back to you.
Fantastic. Thank you much, Sandra. We do have quite a packed agenda for you today, so we are going to try to cover as much as possible and hopefully get to some questions. As Sandra mentioned, I do highly recommend downloading the slides afterwards. There's a lot more information in there than we're likely to get to. So let's get started by looking at some of the economic side of things and how that's impacting the credit industry and consumers. Now, this is the second quarter in a row where we're talking about economic headwinds. I do promise in Q3 I will try to come up with a new word for it. But really, we are still calling it headwinds because not much has really changed from the first quarter. Now, inflation is still higher than we really would like it to be, and that's not just a Canada problem. It's really a global situation, and we're seeing many regions such as the US, UK, Australia, all feeling that same pain when it comes to inflation. And in fact, when you start to compare some of those regions, Canada is actually faring maybe slightly better than some of those other global economies. The reality, though, is that even with some of the work the Bank of Canada is starting to do to try and curb that inflation, 3% year on year. Now, when we take out mortgage interest, which obviously is one of the key drivers that we have currently, that's still sitting around 2.4%. So we aren't too far off that target level, but we have gone a little bit in the wrong direction, fortunately, when we look at July. Now, where is that inflation coming from? Unfortunately, it's still from the essentials, so things like food, as well as housing costs. Now, we did see some improvement on the energy side, with gasoline prices falling almost 13% year on year. But when you go back to 2022, those gas prices were particularly high, so it's dropping from a peak. Now, if any of you have been reading the news recently, you'll know there is a significant risk that inflation may start rising again, primarily due to oil prices. We've seen supply cuts announced last week in Saudi Arabia and Russia, and there also are some strikes in Australia. So unfortunately, they may start to creep back up again. For several months, we've actually been talking about the savings levels of consumers here in Canada and some of the buffer that was given to individuals to really help storm those higher inflation levels. Now, the less good news is that saving rate has almost returned fully to pre-pandemic levels. We're also starting to see employment levels creep back up again, although they are still relatively low, sitting at around 5.5%. Now, when you start to break down those saving levels and look at them from an income range standpoint, unfortunately, it is also showing that widening gap between low and high income. So if you see the charts on the slide right now and look at the low and mid-income consumers, we're actually seeing those saving levels are in a worse position than pre-pandemic, whereas for higher earners, it's kind of reverted back to where they were. And that's starting to show a little bit as well when we look at the credit industry and we see where that financial stress is coming in between those lower and higher income individuals. Now, of course, the big thing that we're all monitoring right now, and it's something that we've all been talking about for a little while, and we're going to be talking much more about it today, is really around interest rates and what impact that is having on the consumers and their credit usage. Now, again, when we look at this globally, we are seeing a similar response with jumps in interest rates to try and help curb that inflation situation across many regions. And unfortunately, if we do start to see some of those gasoline prices rise again, that's going to put additional pressure, not only here in Canada, but on those other countries as well. And of course, it's going to be a big conversation around what happens if inflation does start to rise much, much higher again, and what will happen with the interest rate side of things. Now, one of the more pronounced differences that we see in Canada compared to some of the other regions is that high population growth that we have from immigration. And that really is continuing to impact the credit market here in Canada. At an overall level, our debt reached $2.4 trillion at the end of Q2. That was up around 1.2% compared to the first quarter. Now, on the mortgage side, that was up around 1%, and that's typically lower than we would expect at this time of year. So from a seasonal standpoint, mortgages are definitely down. And that's not really a great surprise because we have those higher interest rates starting to impact the housing market, as well as refinancing, which has really been dropping. Non-mortgage debt was closer to 2% increase, which was a bit more typical in terms of what we would expect in the second quarter. We often see the second quarter seeing a rise. And one of the reasons that non-mortgage debt is still showing that good growth is from that increasing population. We are seeing consumers in general becoming more credit active, but the new entrance into the country continues to be a huge growth area here in Canada. Now, when we start to break that down and look at those new to credit populations, those where we have a credit file less than 2 years old, we start to see quite a big difference in terms of credit behaviors. Those newer credit consumers, on average, they're actually taking on a little less non-mortgage debts than they were 12 months ago, with the average non-mortgage debt per consumer falling around 11.5%. Maybe because those consumers are postponing some of that initial spending, maybe when they arrive in Canada, or if they're younger consumers, maybe pulling back a little bit while those borrowing costs are quite high. On the flip side, when we look at those consumers with slightly more established credit histories, we're seeing their average debt levels rise by closer to 2%. Now, on the flip side, and probably unsurprisingly, there is far more newer consumer activity for that new to credit population as volumes have risen. And you'll see that in the green coloured writing on the bottom left-hand side. So compared to 12 months ago, that non-mortgage debt, it's currently $21.3 billion higher than it was. And around 58% of that growth is really coming from credit card balance. Now, those credit card balances rose $12.6 billion in the last 12 months. And when we actually break it down to a quarterly level, around $5.4 billion of that was in this quarter compared to Q1. So that's around a 43% of that total that's coming in the last quarter. That sounds a lot. It's actually not particularly unusual. Again, pre-pandemic, we always saw Q2 tended to be a period of high credit card balance growth, and that's kind of come back now that we've kind of passed the COVID months. Unsecured line growth has also been really strong in the last 12 months, rising by around $3.7 billion. So that population growth continues to be a real driver of some of the change. But what about those interest rate rises and some of that economic pressure that we've been seeing? Kind of what is the impact we're starting to see there? And when we look across the industry, there are really 4 key themes that myself and the team are going to be focusing on today. Firstly, there are signs of some slowdown in terms of credit demand, credit usage, some spending behaviors. We're starting to see some movement starting to come through. Secondly, we're actually seeing consumers starting to be a bit more prudent. We're seeing more shopping around behavior. We're looking at consumers maybe switching what products they opt for in order to kind of get the best deals. Thirdly, and probably again unsurprisingly, on the mortgage side, we're starting to see some indications of vulnerability coming into that population with those high interest rates and some of the impact that is going to have on minimum payments. And finally, just in general, unfortunately, we are seeing financial stress starting to rise. So we're going to be digging a bit more into where some of that is coming from. So when we look at credit demand, and again, as we start to feel and see some of the impacts of those borrowing costs remaining high, if we ignore that new to credit group, if we ignore those consumers who maybe are coming from the immigration side and just look at those consumers that have had a credit file for more than 12 months, we're actually seeing quite a pullback in terms of credit demand. It's around 2.2% drop in terms of consumers applying for new types of credit in the last quarter. Now, when we look, of course, at the green bars on that chart, which is the new to credit, they, of course, are still remaining high. That's the big growth opportunity still in that new to credit group. So that's the first thing we're seeing. Unfortunately, the second thing is around the number of consumers that are starting to miss at least one payment. That grew last quarter, it's continuing to grow, and we're seeing that movement across all products now. So when we look at our 30 plus balance delinquency rate, so this is where consumers have missed one payment or more, and we're looking at the balances of some of these products, there are some pretty large jumps that we're seeing year on year, in particular for secured and unsecured lines of credit. We're also seeing mortgages starting to rise as well in terms of those 30 plus balance rates. The good news is that for some of those products, those levels are still firmly below where we were pre-pandemic. So mortgages, for example, are still around 36% lower than pre-pandemic. However, it is changing for some products. So on auto loans, on unsecured lines of credit, they have now fully surpassed the 2019 delinquency levels. Installment loans are starting to get closer. So we are seeing this financial stress picking up a bit of pace. We're starting to see it exceed some of those pre-COVID levels for certain products, and some of the other ones are really starting to catch up again. Now, at a consumer level, it is both consumers who have a mortgage and those who don't have a mortgage where we are seeing the increases coming through in terms of missed payments. Mention both of them just because it might seem a gut instinct that, well, high interest rates is going to be mortgage individuals that are mostly impacted, but it is across both. And some of that's really coming from that continued high inflation. Cost of living is still very, very high. So it's everybody who is feeling some sort of pressure. But there are likely different factors for each group coming through. Where we are starting to see, though, a bit more of a difference between those two groups is when we look at insolvencies. And in particular, we're seeing this on consumer proposals, where the change in volumes over the last 12 months have increased by more than 42% for those consumers that have a mortgage. When we look at the other population, those that don't have a mortgage, that's around 25%. So quite a big difference in terms of that jump we're seeing on the consumer proposal side. Now, proposals are there as a tool to help manage financial stress if you have assets. So perhaps we may expect that we actually would see a little bit more coming through for that mortgage group. Now, one of the interesting things we are starting to see a little bit when we still look at the insolvency levels, and this is something we actually saw back in 2018 and 2019 when interest rates last rose, is some divergence starting to creep in around the levels of delinquency rates where consumers missed maybe 90 days or more on making a payment, and those proposal rates. So if you look at the left-hand chart, you'll see there the proposal rate in red, you'll see the bankruptcy levels in blue, and that grey line is that 90-plus delinquency. And just towards kind of Q2 and Q3, we're starting to see a bit of separation between the red and the grey line. So it's a steeper increase rate for consumer proposals than we're seeing on delinquencies. And what this really means is that we are seeing a uptick in terms of insolvencies that are coming through where we class them as surprise. And by that, I mean there is little or no warning of stress before that insolvency is filed. So that's really something to keep an eye on. Now, one of the reasons we're seeing these delinquencies rise and the insolvencies creep up is, of course, that consumers are having to pay much more to cover their debt commitments than they had to previously. So when we look at monthly minimum payments for all products, we are starting to see those rise, and in particular for those variable rate products like home equity lines of credit. Those ones tend to be a bit more directly linked to interest rate rises. So when you look at that left-hand chart, you'll see home equity line of credit, the minimum monthly payment has risen by around 42% in the last 12 months. And that can be quite a significant jump for a consumer in terms of making those payments. Now, I say we're looking at that at an overall level because, of course, for some products, this increase is only really going to start to materialize when a new product is issued. So, for example, auto loans, it's only when you maybe switch and get a new loan that you start to see that jump in terms of payments. So on the slide, we have an increase here of 5%. That's across both new and existing loans, so kind of a blend of what's happening with monthly payments. But of course, if we were to look at just new loans in isolation, it's a much, much higher increase. Now, one of the early warning signs we monitor closely is around credit card payment behaviors, and they tend to be a really good early indicator of financial stress coming through. And one of the measures we look at is how many consumers are paying their balance in full, so how many of them are transactors. As we see that level drop, we often see delinquency levels rise after that point. So when we look at this currently, overall, we're seeing the percentage of credit card transactors, those consumers who are paying in full, that's fallen around 1.7% in the last 12 months. Now, if we pull a subset of those that have very high variable rate balances, so consumers with HELOCs over say, a $50,000 balance, we see that's dropping much faster. It's almost a 6% fall in the percentage of transactors. And again, this is something we saw back in 2018, 2019, and delinquencies and insolvencies, unfortunately, did follow. So I've talked for far too long already, so maybe let me hand over to Kathy, and she can share some thoughts with you around what all this means for lenders right now. Kathy.
Great, thanks, Becky. So before I touch on what lenders should be thinking about, let's recap some of what we just heard from Becky. So while the overall credit demand has slowed down, we still saw that significant jump in credit usage from consumers with newer credit files, which again is correlated to immigration and those that are new to credit and new to Canada. We also saw that the interest rate hikes have impacted the cash flow for consumers, given that the minimum for the minimum payment of products like HELOCs, these amounts have actually increased. And so for consumers with cards, we're seeing more move from being that transactor, again, paying it off in full each month, to becoming revolvers, given their other credit obligations. Last important note I just want to call out is really sort of what we heard in terms of that financial stress coming through faster in terms of seeing an increase in those surprise insolvencies versus that 90-day delinquency. So taking a pause right there, let's just glance quickly at what's been happening globally. And what we see is that the interest rate hikes in many other countries have also been impacting that credit market. Similarly, we are seeing that missed payments are starting to increase on non-mortgage products year over year for all consumers. Again, this is happening not just here, but across the world as well. So coming back to Canada and coming back to sort of the key theme here on this slide is, what should lenders be thinking about? So first off, when it comes to growth, we're seeing this really being driven by that new to credit, new to Canada population. If lenders want to grow, this is a key segment that you're going to need to target, attract, approve, and grow with as they embark on their credit journey while they establish themselves here. Make sure your strategies understand who may fit into the segment and assess the risk accordingly. This is definitely not a segment that you want to lose opportunities with. When it comes to risk, this is where it's going to be very important as a lender to really have that holistic approach as to what is in the consumer's wallet, right? Not just with your institution, but with others as well. What is their financial position means understanding that cash flow when it comes to payment obligations across all products. And such, having really good account management strategies or a monitoring program is going to ensure that you understand the health of that consumer's financial position and how it may be changing due to the economic changes that we constantly see happening. So I'm going to take a pause right there, and I'm going to pass it over to Swarnima, who's going to help us move into the card industry by tapping into what's been happening there.
Thanks, Kathy. Before we move to the credit card section, there are a couple of questions that we can answer. So Becky, I think this is for you. What is the main macroeconomic factor that will drive delinquency in 2024?
A great question. I mean, I think interest rates are definitely going to stay up there as we start to see that mortgage population come up for renewal and on some of their terms. That is definitely going to put some stress on those individuals. For some individuals, they may be able to extend their amortization term and things and kind of balance out some of those payments. For others, maybe they might not have that option. So I think that's going to be a continued challenge. And linked to that is really going to be inflation. So, if you're not a consumer that has a mortgage, when we look at the non-mortgage group, they are still experiencing those higher cost of living. As inflation stays high, that's really going to put a lot of stress on that group as well. I mean, I think when you look at things like unemployment levels, because we've had such a strong job market here in Canada, for the moment, I don't think that's too much of a concern. It's really going to be the inflation and the interest rates.
Thanks, Becky. There's another question on auto delinquency projections, but I think I'll cover that in my section.
Okay.
So let's start with credit cards. Credit cards have been the biggest driver of non-mortgage debt in the last 12 months. Credit card balance is at a record high of $107 billion. While new card originations are being driven by new-to-credit consumers who are a major contributor to this balance growth, it's also the lower paydowns on credit card balance, which is now affecting the credit card debt levels. Let's first look at the payment rates. Payment rates for credit cards are the amount of outstanding balance paid by the consumers at the end of each month. Now, pay rates increased dramatically during the peak pandemic period. Payment deferrals, government initiatives helped many consumers in paying off their credit card debt. But now, as you can see from the chart, pay rates have started to go down again, and we are seeing a bigger drop in pay rates, especially for mortgage holders, who usually have a much higher payment rates. This has led to an increase in credit card balance, which is visible across all consumer segments, especially if you look at consumers with lower credit scores. So any consumers below 622 credit score, that's where we're seeing the maximum increase in credit card balance. And even though they form just 13% of overall credit card debt, but their average credit card balance is rising at a much faster rate than the average consumer. Now, looking at new originations, we are seeing a huge growth in new originations, a lot of it which is driving the credit card growth. Even this quarter, we saw over 1.5 million new cards issued. Even the previous quarter, it was close to 1.5 million new cards. So new to credit consumers tend to be a big part of new card growth, with 27% of new cards coming from new to credit consumers. So younger consumers just entering the credit space or people who are new to the country. New card growth was also fueled by high credit limits. We have seen this trend in the last few months. In the last 1 year, lenders have been offering higher credit limit on new cards. Average credit limit on new card is close to $6,000 now. It's over $1,000 more than what you would expect pre-pandemic. But lenders are being cautious as credit limit for lower score segments have started to see much smaller increments in 2023 than what we saw in 2022. We are also seeing a slowdown in credit card spend. Average monthly credit card spend per credit card consumer increased by 3.7% year over year for this quarter, for Q2 2023. But when you look at Q2 2022, that increase was 22.7%. And now credit card spending has been consistently growing since the end of 2021. And now it's finally starting to slow down, and partly due to inflation drop, partly due to rising financial pressure from higher interest rate credit products. As mentioned by Becky in the previous section, minimum payment requirements on all credit products have gone up for most consumers, and it has made many consumers pull back on credit card spending. So spending is not rising at the same level as it did last year. The slowdown in credit card spending seemed to be more prominent among mortgage holders and high income segments who have the flexibility to scale back on discretionary spending to meet their increased credit payments. However, it's the lower income households where consumers are struggling, savings rate are lower, consumers who are not paying their credit card balance in full, this credit card revolvers, are not able to cut back on their spending. And we are seeing their spend levels is still going up. For this quarter, it went up for June, it went up by 7.1% as opposed to transactors, where we only saw an increase of 1.2%. Now, as payment rates are going down and debt levels are increasing, so is the financial stress. So despite high balance and spend, credit card delinquencies remain lower than 2019, but the levels are starting to rise. Some of the increases in delinquencies are being masked by the new credit growth. But when we look at delinquency rates of newly opened trades, so a trade that has been open for 24 months, the delinquency rate for these trades are much higher than others. And as of 2023, cards open in 2020 and 2021 are showing the biggest jump in delinquency, especially those with lower scores at origin. While delinquencies are slow to rise, if we look at the dotted line in the chart, it represents the credit card delinquency rate in the US, and it shows a bigger increase than Canada, and it could potentially be a good indicator for future delinquencies in Canada, as often the economic changes in US gets reflected in Canada as well. Regionally, we see the biggest increase in delinquency coming from Ontario and British Columbia. So provinces with higher cost of living are seeing more consumers miss payments. And mortgage pressure could also be affecting the card payment for these provinces. While credit card delinquencies have been slow to rise, if you look at delinquency rates for both secured and unsecured line of credit, they have risen sharply in the last 12 months. The impact of high rates is clearly taking a toll on line of credit user. Late delinquencies on these products have still not exceeded the peak of pre-pandemic, but early delinquencies from many consumer segments, both secured line of credit and home equity line of credit, have surpassed the peak 2020 levels. Unsecured line of credit, the pressure is more visible for younger consumers, so consumers under the age of 35, whereas for home equity line of credit, it's mostly impacting seniors who have a much higher share of HELOC balance. Credit card payments are getting impacted by high interest rates and inflation, and consumers are either pulling back on spending or starting to miss payments on revolving products. I'll hand it over to Kathy now to explain what this means for lenders.
Great, thanks, Swarnima. So as always, again, we just heard lots of great insights. So just to quickly recap some of the highlights, we're at a record high when it comes to credit card balances, and we're seeing that big decline as well when it comes to payment rates. Consumers are trying to use their cards less, given this pressure from the higher cost of living, especially those that live in really expensive Canadian cities, and even more so from the lower income families. The inability to pay off a credit card balance is what's leading us to see more revolvers, right? So those that are now carrying a balance into the following cycle, now with interest on top. The other key insight that was mentioned was for the lines of credit, where we're seeing that senior demographic. So those that are on fixed lower income levels, they're really driving delinquency rates as well. So on a more positive note, though, what we also heard was for new cards originated, a lot of the tremendous growth is coming from that new to credit, new to Canada segment. Pausing again, sort of on Canada and taking sort of a quick glance at the global perspective, what we see here happening in Canada with regards to the card market is really no different than what's happening in other geographies like the US, the UK, and Australia. So as we just heard, but really sort of staying close to any emerging trends is going to be important, just in case there's a fast follow here in Canada. So speaking of Canada, what should lenders here be thinking about when it comes to the cards market? So again, when it comes to growing your book, it really means that looking at both new customers, but also expanding the relationship with existing non-risky customers. We've mentioned the new to Canada, new to credit segments, because given the aggressive immigration plans, this is going to be a key segment when it comes to new acquisitions. In addition, for other new acquisitions that come from riskier age or income segments, this is where you're going to make sure that your policies are refined to really reduce of exposure. For existing customers, again, something that we recommend to all of our customers is conducting an important analysis like the share of wallet. That'll allow you to understand, the position of your card in the wallet and the likeliness of expanding that relationship or moving, your card in their wallet up, and where usage of that card can increase with minimal risk. Alternatively, looking at sort of key pockets within your portfolio that you want to monitor can also be used for, targeted growth strategies, upsell, cross-sell opportunities, or CLI, driving CLI campaigns. But you can also leverage sort of, a monitoring program here to assess the pockets of consumers that are experiencing that financial stress that we continue to hear about, that may be on that slippery slope headed towards delinquency or insolvency. This is where it's going to be important to have these mitigation strategies that help you sort of see so that you don't have a surge in your collections stream from there. So, parking this conversation on cards, let's now take a drive. Let's dive right into hearing what's been happening with the auto industry. So Swarnima, back to you.
Thanks, Kathy. Auto is another credit space where we have been seeing a lot of changes, especially in the past 1 year. New originations have risen in 2023, and so has auto delinquencies. Let's first look at new originations. New auto loan growth was primarily driven by younger consumers, so consumers under the age of 25. Auto leasing activity showed a seasonal recovery this quarter, which has been declining continuously for the past 12 months. We are also seeing a bigger increase in subprime and deep subprime consumers who are taking a new auto loan this quarter versus what we saw last year. Most of the auto demand is still being driven by used cars. Used cars remain the preferred auto option for most consumers as new car affordability continues to decline. Now, compared to the peak Q2 2020, new car average loan amount went up from $40,000 to $48,000, and it continues to increase year over year, even though the increments now are much smaller than what we saw in 2022. But used car prices also skyrocketed, with average loan amount went up by $8,000 from 2020, but the levels are starting to slow down. Like, we did see a year-over-year drop in used car prices this quarter. And after a small drop from last quarter, the average used car loan amount still remains at $34,000, which is still quite high for used cars. Higher loan amounts have pushed average amortization term for used car over 72 months, which was not the case pre-pandemic. Vehicle prices are expected to go down, but cost of borrowing remains high, with average interest rates for used car being 10% and for new cars 7%. And all this contributes to the much higher cost of maintaining these auto loans. An average new auto loan holder is paying more than $160 as auto payments when compared to someone who took an auto loan in 2019. We are also seeing that many consumers are looking for alternative lending options for their auto loans. And this is where consumers are using either unsecured line of credit or home line of equity to reduce monthly payment costs for auto. Many consumers are paying off their auto loans early or nearing term by using a line of credit or a HELOC, a trend which is very similar to what we saw in 2019 during higher interest rate period. There's also a section of consumers who are either getting a new line of credit along with an auto loan, or using an existing line of credit to pay a portion of the auto loan. So moving balance from loan to line might not work for many consumers, but this could be helpful in reducing payments, especially for high-scoring consumers with a HELOC who are trying to pay off their used car loans. It could also provide minimum payment flexibility for many consumers who are struggling to pay their auto loans. And high auto loan costs are having a bigger impact on consumer credit payments. Now, auto loan is a credit product where we are seeing higher than pre-pandemic delinquencies. And auto loan delinquencies actually peaked in the second quarter of 2020, right before the pandemic, and currently have surpassed the peak levels in this quarter. And the biggest increase in delinquencies that we are seeing is in the age segment, 26 to 45. This was also the segment which contributed to a huge growth in new origination back in 2021. Though early delinquencies are a little volatile, we can still expect more accounts rolling from early to late delinquencies due to higher auto payments. And while new car arrears are rising, it's the used car segment that showed the biggest increase in late delinquencies. And as discussed before, used car market has undergone a lot of changes since the pandemic. Higher prices, expensive cost of borrowing, everything has contributed to pushing auto delinquencies up. Even for this quarter, again, we looked at auto vintage delinquency view to see where the delinquencies are originating. So the chart shows 90 plus account level delinquency rate across different score groups at the origination of auto loans. So delinquencies are being driven by newer auto loans. So or loans that opened in 2021 and 2022, they are missing payment at a much faster rate after 12 months of opening. And bigger impact has been on subprime and deep subprime consumers. Also used car auto loans with high interest rates where consumers have a much higher loan to value right now are struggling with higher monthly payments on auto. And this has all contributed to the rise in auto delinquencies, and auto payments are getting challenging for consumers, and we can expect more missed payments in the future. I'll hand it over to Kathy again to tell what this means for the auto industry.
Thanks, Purnima. So being able to afford a vehicle really has changed significantly since the start of the pandemic, where we had the supply chain issues, then we saw higher demand, we saw the surge of pricing, everybody moved over to the used car market. And then when we fast forward to today, now we've got the higher interest rates, which are another significant factor, really impacting that consumer's ability to afford a vehicle. So as a result, in the used car market, we see many taking on loans with even longer terms just to be able to pay it off. Others have resorted to using their lines of credit with lower interest rates to pay off the existing loan, or just using it instead of a new auto loan altogether. Again, consumers are really trying to be savvy and looking for ways to overcome that affordability challenge. But the concern is this, right? So as the higher cost of living pressures mount, there's that fear, again, that delinquencies are going to be sort of an unfortunate outcome. Last thing I just wanted to call out that we heard from Swarnima just now is that we've also seen an increased demand for new loans coming from that subprime market. So shifting gears a little bit and taking a quick spin around the world, we've seen good growth with regards to new originations across the globe, right? And that's because of the correction of the supply chain issues. But when we look at the UK and the US, we're starting to see delinquencies already back up to pre-pandemic levels. So given what we've heard, what should auto lenders here in Canada be thinking about? So for starters, if we look at those that bought a used car vehicle in the last few years, again, we mentioned higher price points, hence LTVs, longer terms, higher payments. This is the part of the portfolio that's going to be very vulnerable and will need to be monitored a little bit more closely, given that as the asset depreciates in value, that loan actually might be higher in value. And if that consumer then experiences any type of financial stress, well, obviously defaulting on that loan will be very likely. Again, as always, stay close, make sure your risk policies, your strategies are sort of fine-tuned by evaluating them and optimizing them to minimize any type of risk exposure. This is a best practice and something that you should be doing regularly. Same goes with the collection strategies, right? Review them, optimize them so that you're in a position to really minimize your losses and maximize your recovery if it comes to that. We talked a little bit about the subprime segments really seeking loans. Make sure, again, your risk policies allow you to evaluate the credit data from these individuals. And perhaps you might need to also look at alternative data to ensure you're making really good decisions when it comes to approvals. Last thing, as a lender, The interest paid on that loan over the term is what really drives profitability. So just be mindful of consumers who have that potential for an early payout, which plays a part in how profitable you're going to be in terms of how you structure that deal. Look to understand whether or not that consumer does have access to lines of credit and what their utilization rate is to see if there is a possibility perhaps of that early payout happening. So on that note, let's park this conversation here with regards to auto and move right into talking about mortgages. Swarnima, back to you.
Thanks, Kathy. Moving on to mortgages. Mortgage demand is up again from the initial slowdown that we saw towards the end of 2021. Overall mortgage balance increased by 3.4% when compared to last year. And some of the three key drivers of this growth were increase in new mortgage originations, increase in the average loan amount, and the slower reduction in balance as consumers either missed payments or are paying lower portion of their principal. So let's look at mortgage originations first. House sales were globally impacted by rising interest rate. And as we can see from this chart, home sales in both US and UK follow a similar trend like Canada after the interest rate started increasing in 2022. However, if you look at the blue line, which is Canada, home sale in Canada has started to jump back up again since April. And this has led to an increase in new mortgage volume this quarter. So this chart shows new originations as well as average loan amount on new mortgages. And though new mortgage volume is still lower than what we saw in 2021 and 2022, but it has grown from last quarter. So new loans were up from last quarter, and so was the average loan amount. Now, home prices are no longer going down, and we see loan amounts rising from last quarter for cities like Toronto and Vancouver, which saw the biggest drop in home prices, now are starting to see that prices average loan amounts are going up again, and their average loan amount remained over 500,000, and it has started to go up from Q1. Now, new mortgage originations normally include renewals, refinances, new property purchases, and first-time home buyers. But this quarter is the first-time home buyers, which have outpaced the overall growth in new mortgage loans. And the initial rate hikes made many first-time home buyers delay their purchases, but we are already seeing a bigger increase in first-time home buyers from Q1 2023, despite higher interest rates. Now, the levels are still much lower than what we saw in 2020, 2021, but still, it is an increase from last quarter. The chart here shows year-over-year change in average loan amount and monthly payments for first-time home buyers. While the loan amounts have dropped from last year, but the average first-time home buyer is paying more than double in monthly payments than a first-time home buyer back in 2022. And higher loan amounts have also impacted the amortization term on these mortgages. Now, a much bigger portion of first-time home buyers have an amortization term on their mortgages over 25 years. And amortization terms on new mortgages, as well as extending terms on existing mortgages, is moving the mortgage portfolio slightly towards higher loan terms. Based on monthly scheduled payments and balance movement, we have modeled rate and amortization term estimates for the mortgages. And based on our estimates, if you look at mortgages open in or before 2019, the variable percentage mortgages were very low, and very small, much smaller percentage of mortgages that ended up over 25 years term. But as you look at 2021 and 2022, we are seeing an increase in longer term mortgages with increasing variable rate preference. And as of 2023, some mortgages have a term longer than the age of retirement of the oldest mortgage holder. So many of these consumers will not have an option of extending their term to reduce monthly payment upon renewal, and could cause more financial stress for these consumers. Now, high monthly mortgage costs have started to make mortgage holders financially vulnerable. Mortgage delinquencies are rising from the lows of 2022 But for provinces like Ontario and British Columbia, again, it's rising at a much faster rate than other provinces. Both these provinces were the hottest housing markets, where we saw the maximum jump in house prices, maximum jump in loan amounts, and overall mortgage growth. And high monthly payments coupled with higher cost of living in these provinces are pushing delinquencies up. And these are being affected by multiple factors. The first would be payment shock from recent mortgage renewals, putting pressure on mortgage holders who are struggling to keep up with higher rate payments. But the most impacted are consumers with a variable rate mortgage where payments have been going up since March, or where payments were steady, but their principal portion of the payments kept reducing, and now they have hit a trigger rate where they are paying interest only or required to pay a lump sum amount to avoid negative amortization. And rate change impact is definitely more visible on consumers with a variable rate mortgage, especially those who took up a mortgage in 2021, when the rates were much lower. As you can see from the chart on the left side, the gap between the average interest rate at inception versus the current rate is maximum for variable rate mortgages that were open in 2020 and 2021. And if we look at vintage delinquency rate chart on the right, delinquencies for these mortgages remained low up till 2022. But in 2023, after 24 months from opening, they're starting to rise back again. And we're also seeing a similar increase for newer mortgages, especially if they originated from lower score consumers. I'll hand this back to Kathy again to explain us what this means in terms of growth and opportunities.
Awesome. So thanks, Farnima. So as we've heard throughout this presentation, and really to help summarize some of the key insights for this section, we're going to continue to see high immigration, which is going to fuel credit demand, especially including new mortgages. Additionally, those that have a fixed rate mortgage that are up for renewal, they're going to be very vulnerable to the interest rate hikes, which can lead to payment shocks at renewal time. Lastly, we're starting to see signs of financial stress come in the form of mortgage delinquencies, which are being driven primarily by consumers in Ontario and BC. And really, given that mortgage is at the top of the payment hierarchy, we're talking about some serious financial stress happening here for these consumers. Quick glance globally, we saw that in the UK, there's a pocket of consumers whose mortgage term extends past their 70th birthday, while down under in Australia, consumers there are sort of looking for ways from mortgage lenders on how to accommodate payments. So coming back to sort of, what should lenders be really thinking about in the mortgage space? First off, when it comes to mitigating risk, it's really all about staying close to the consumer in your book to see if there's any signs of that financial stress really starting to come through across all credit obligations and credit and payment behaviors. Again, are you starting to see delinquencies sort of in other products that are part of that consumer? Is there a shift in sort of payment behaviors? Are they sort of decreasing that payment amount and the payment rate? Again, these are some of the early warning signs that a consumer might be experiencing that financial stress. So it's going to be important to sort of be on top of looking out for them. From a renewal perspective, it's all about sort of proactively working with your customer, again, especially those that are on that fixed rate that we just talked about. Looking at ways of, is there an opportunity to structure that loan to ensure you're minimizing as much as you can any payment, right? Taking that extra step is going to help build that trust and that loyalty with the consumer and really minimize any likeliness of attrition. So on that note, and I know we've gone through a lot of key insights and a lot of takeaways and a lot of things that the lender should be thinking about. So I want to take a step back from sort of the product level and really leave you with sort of three key overall themes from today. First thing I want to just call out is, yes, the interest rates were held last week by the Bank of Canada, but it's clear that the full impact of all the hikes, have not yet been seen. So I think there's going to be more sort of outcomes that are going to come apparent in the coming months and quarters. Second thing, the impact of what's happening in the economy is really applying more pressure to those that fall in the lower income and younger segments. So those are the segments that are really sort of feeling it even more so. And last thing, and again, it's been a theme throughout the presentation, is when it comes to the opportunity for growth, again, immigrants are going to be a key segment to really stay close to. So I believe I'm going to pass it back to Becky, who's going to walk us through. I think we've got quite a few questions from our audience to answer.
Yes, thank you, Kathy. And I just want to say I did appreciate some of those puns, Kathy, that you were throwing in there with like driving and parking on the auto. Definitely appreciated those. So maybe if we stick with mortgage, because that's the most recent one that we were talking about, and maybe Swanima, you can kind of help answer this question. What is driving the first-time home buyer numbers? Is there a correlation to immigration in terms of kind of what's going on there, and maybe even rental properties?
Yes, sure. So first-time home buyers, definitely the demand is up due to a lot of much higher immigration that we are seeing right now. Like the immigration numbers slowed down back in 2020, 2021, and the immigration targets are high. And we are seeing more new to credit as well as new to Canada consumers. So a lot of new to credit consumers are older, and we estimate them being new to the country, and that is driving a lot of demand for first-time home buyers. And even in general, like the home prices are not as low as we expected, but they're still lower than what they were at the peaks in 2021. So a lot of first-time home buyers would still want to tap into that lower home prices before they start to rise again.
Amazing, thank you. Another question, do we have an idea of the most used solution to limit the increase in payments when renewing the mortgage loan? So I know I've heard a little bit in terms of more consumers securing shorter term periods for starters and extending the amortization out to really get those payments down. I don't know, Swanima or Kathy, if you've, speaking to lenders, is there anything else that's really coming up as being the most common that we're seeing right now?
I think it would definitely be extending the term or keeping the term same to reduce the monthly payments and reduce the payment shock, especially for some consumers. I think for some consumers, they can still absorb the higher interest rate payments, but a lot of consumers might want to keep their payments same and just extend their term or keep it the same.
Yeah, and I definitely expect to see. Oh, sorry, go ahead, Kathy.
Oh, no, I was just going to say, Becky, sorry, I'm hearing the same thing, right? I think consumers, again, that are in these positions are looking at sort of extending their amortization because, again, higher cost of living across the board. It's not just sort of the mortgage amount that's increasing, but everything else is increasing. So it's finding that balance to be able to sort of get through this wave.
Yeah, definitely. There's another question. If increase in interest rate is a big contribution to inflation, what would be the rationale in increasing it to control inflation? Which I think is a really great question. I think that's why at the start we tried to show it with the mortgage part removed a little bit. Because I think, the Bank of Canada will be looking at different variations of inflation. Again, Swanima, Kathy, anything else you would add to that?
Yeah, even when we exclude mortgage costs from inflation, the rates are still over 2%, which is still higher than what Bank of Canada wants it to be at. And it's not just the interest rate; it's just a lot of other factors also keeps impacting inflation numbers. So, with or without mortgage rates, we are still at a much higher inflation level that we want to be.
Yeah. So I know there was a question at the beginning, I think from my section, I'm struggling to find it, we have so many questions, but it was really talking about the difference between those mortgage and non-mortgage consumers, and actually rental costs play quite a big role when looking at non-mortgage, and absolutely completely agree. They definitely are on the rise, and that's one of the things that's going to be contributing towards some of those delinquency levels that we do start to see for non-mortgage consumers, because things like rental prices are increasing. I think kind of one of the differences you do get to an extent between mortgage and non-mortgage, or mortgage and rental, is those payment shocks on mortgage are a little bit more finite. As you kind of come up to term, there is going to be a definite increase if you secure your term on a much lower rate. So I think it's a little bit more definite for the mortgage holders, which is why we're a little bit more concerned about that. But absolutely, rental is going to be a key contributor to some of those non-mortgage financial stress cases coming through. So we did have a few questions on the auto side. So I guess one of a few, did the auto loan numbers include the manufacturer's financing arms such as Ford Credit or GMAC?
It would. So we do have auto loans from non-bank lenders, captive, as well as banks. So it will include all of the auto loans that gets reported to us.
Okay. How long do you anticipate used car prices to remain high? So I know on one of your slides, I think we were just starting to see, and obviously we see the loan amount as so much as compared to kind of the prices. I know we've seen used car loan amounts starting to now drop slightly in the last quarter. Any thoughts on that one?
Yeah, but it depends what is the new normal, because the average auto loan amounts went up in 2021 and 2022 by over 20%. So I don't think so. So it depends on what we expect it to be the new normal or low auto loan. Are we expecting back to 2019 levels or just slightly lower than what we saw in 2022? So, but they are going down, but not at the same rate that it will reach 2019 so soon.
Yeah. So not so much a question, but there was a comment around new car sales. They're actually up around 9% year to date. One of the things being heard in the industry is that there are more cash sales. And obviously from an Equifax standpoint, we don't necessarily see that in our data. Yeah, absolutely. I mean, one of the things that we have been looking into, and that's one of the reasons I guess one of them was showing some of the switch where we have seen some movement of using different lending options to purchase their vehicle. We certainly have seen as well more inquiries that actually don't then appear as a loan anywhere. So that would kind of support some of the cash sale potential that's in there. Now, of course, the challenge with cash sales is you need to have enough financing to do a cash sale. So that tends to be more on the higher income, whereas you start to go into some of the lower income, perhaps they're not going to have the opportunity, particularly on the kind of new car sales standpoint. Anything else? There was an increase in financial stress may lead to rise in financial fraud. Has such a trend been observed? And I will, in a couple of minutes, be introducing just some information around a fraud webinar that's upcoming. But I guess high level, Swanima, anything on the fraud side?
So fraud levels are slightly lower than what we saw last quarter. But again, this is again to do with the increase in mortgage applications again. Like in the last quarter, we saw a big dip in mortgage applications. So we saw a much bigger increase in fraud rates. But fraud applications like for secured loans like mortgage and auto is increasing but it's not increasing at a very high rate. It is still a smaller increase from last quarter.
Okay, fantastic. And then just two questions we didn't really get into in great detail, and we will give more information at our next webinar, just because we will be focusing a little bit more in terms of what's to come in 2024. But those two questions around projection for insolvencies and what the outlook looks like for 2024, and one around auto loan delinquency. So I know maybe if I just touch on the insolvency side, bankruptcy levels still quite low. We do expect them to start slowly creeping back up again in terms of full bankruptcy. They've actually been really quite flat for quite a period of time with a little bit of increase coming through. On the proposal side, we do expect that to keep increasing, particularly as we see more stress coming through or vulnerability coming through on the mortgage population. As those payment shocks come through, proposals are going to be an option if they have large levels of debt elsewhere. Potentially, they might use that to try and relieve some of that pressure. I don't know, Swanima, any thoughts on auto loans in terms of delinquency?
Yes, so auto payments, as I mentioned before, are very high, and we are seeing a much bigger increase in auto delinquencies than other credit products, and they are already past the peak delinquency levels that we saw in Q2 2020, especially for the early delinquencies, and especially if we segment it into age groups or used car and new cars, we are also seeing a much bigger increase for certain segments. So we definitely expect auto delinquencies to go up, especially for consumers with a used car with a higher loan to value loan, as well as consumers with much higher auto payments than than consumers who got an auto loan back in 2019.
Okay. And like I say, we are hoping to squeeze another consumer webinar in towards the end of the year. If we do, we will try and bring in a little bit more in terms of forecasts. I know we haven't shared forecasts for quite a while, so maybe that'll be an opportunity to kind of go through that. So a couple of things I just want to kind of call out before we end. So first of all, we have our business credit trends coming up. That's on Thursday, I believe, this week, where Sinead Gleason is going to be talking about how businesses are coping in the current economic climate. So definitely sign up for that one if you have the opportunity. And then we also have our fraud trends with some economic insights as well on September 20th. So that's Sharol, Brady and Anouk. So make sure you kind of put those in your calendar, register. There's a lot of great information that we don't get time to go into in both of those sessions. All I want to say finally is thank you so much for joining us again. It's such a pleasure having so many of you come out to listen to us on a quarterly basis, and hopefully we will see you next time.